Hi, I know I've been pumping out quite a lot of bullish video with regards to Meta recently, and some of you might have the impression that hey, Chiking might be blinded by the potential problems around the company. So this video should act as a form of a warning to potential or even to current Meta shareholders on the current predicament of Meta as a company, and by extension, an investment. So I know many of you are highly skeptical about my next big investment because clearly the first one, which is Alibaba, probably didn't turn out that well yet. Keyword here, yet. Unless Alibaba goes missing tomorrow for whatever reasons, we shall see if the investment plays out. Also, I was maybe 1 year too early on Alibaba then. And could I be 1 year too early on Meta too? Who knows? What I know is that you should destroy that like button. That's the only thing that matters anyway. Something else that matters is of course petrol prices. So from now until 30th of June, you can sign up for the Citi Cashback card to receive a Dyson Corel worth $699. It offers one of the highest cashback at up to 6% for dining and up to 8% for groceries and petrol. So with the current runaway inflation, I'm sure you'll appreciate the cashback to offset those pressures. So you can head down to the link below to sign up, and just a reminder, it ends on the 30th of June 2022, which is only in a few days time. So don't let this deal expire away like cheap petrol prices. Now, I've come across a very thoughtful Twitter thread over the weekend, and I wanted to make sure that more of you are aware of the risk-reward Meta provides. So in investing specifically, we are all dealing with uncertainties. The more uncertain a company's outlook gets, the more mispriced the valuation could potentially be. I'm not saying that Meta is a buy of a lifetime for sure, but you should at least know what you're getting yourself into, or potentially getting yourself into. Not going to lie though, I think there are many incredible FinTweet accounts out there that provides phenomenal insights, and mostly borrowed ideas is one of them. So like his or her Twitter handle suggests, this will be based on a borrowed idea as well. So they started off by prefacing that hey, Meta is currently trading the way it does because of 1. Family of apps is presumably terminally ill, and 2. Reality Labs is too speculative compared to capital employed or are going to be employed, which is what everybody is afraid of, the capex costs. Effectively, at least in the social media space, it's hard to quantify the terminal value of your products. It's not as if like you had swaps of lands, factories, inventories, or even brand value. All they have for all these social media platforms are the users. If there is no user, there is no company. Still remember Vine and MySpace? When it died, it died. There was no coming back. So the same can be argued for many of such quote-unquote social media platforms today like Facebook, Instagram, Twitter, Snapchat. You get the point. So this discussion will be expounded further in this thread, but that's basically what they mean by terminally ill. The family of apps are allegedly losing their appeal to most of their user base. So let's take a step back. We know every business will eventually die. All I want to know is where I'm going to die, and I'll never be there. Simple, isn't it? Now, if you were to give someone the task to draw a bear case for Meta today, many will probably make a very credible case to show how Meta's family of apps may be in terminal decline in 2030. So it's possible that the last 10 to 12 years was a bit of an anomaly in social media, when all generations or even age cohorts coexisted in platforms owned by the same company. And the next 10 years may be more oligopolistic in nature. So for those of you who needs the definition of what an oligopoly is, it is where an industry is dominated by a small number of larger producers. So I think the distinction we have to make here is, it's true that Meta's business model is in the digital advertising space. And that has always been a duopoly since a decade ago, essentially monopolized by both Facebook and also Google. But recently, it's turning towards becoming a triopoly with Amazon in the picture as well. However, Meta's main industry is still in social media. Digital advertising is the revenue driver, and at least in the social media space, Facebook has been dominating with a monopoly position for quite some time now. So we all know of the existence of Twitter, Snapchat, and all its likes, but it has never been the go-to platform for most of us. Moving forward though, it does seem like the trend is currently boomers on Facebook, millennials on Instagram, and Gen Z on TikTok. So it doesn't mean that millennials or Gen Z won't use TikTok or Instagram, but rather each generation will have a distinct dominance in these platforms and the cycle will go on. However, The distinct point to note here is that from day one, Meta's bear concerns remain the same. You only need to lose one battle, and one battle only, once you die, even if you won all previous battles. It doesn't matter, and hence investors may be under permanent fear and give it a low multiple. Besides, with zealous regulatory environment, platform dependency, i.e. Apple's bag of magic tricks, and a potential recession in digital advertising, there is no shortage of concerns out there. So Mark Zuckerberg probably knows the bear case better than any of his shareholders out there, and he knows exactly how his empire is going to eventually die. All he's trying to do is to avoid that path now. While many shareholders may want him to focus on the core app business so that they can sell at a good profit few months or few years out, Mark Zuckerberg wants to build a company that lasts for decades, like most entrepreneurs do. So shareholders who are hoping for an unwinding of the Reality Labs investment will almost certainly be disappointed if you were to follow this train of thought. Side note, Reality Labs' 2-year revenue CAGR was 113%, and it will be crucial to see how they ramp up the next 3 years. So the greatest entrepreneurs are risk killers. They think about killing failure paths. They also understand that risk and value can change form. When risk has been killed, then value has been created, and a subsequent investor coming in should pay for a higher price for a percentage ownership. So Zuck is trying to kill the quote-unquote failure paths, and we will have to wait and see whether he can navigate to the other side in one piece. So I think there are just 3 main points that I wish to emphasize from this thread. Number 1, you need to understand the prospects of Meta if you are intending or considering to invest today. You are betting on Mark Zuckerberg, period. This is not a turnaround play where you are waiting for market cycles to turn around. Although Meta Platforms is not like some random startups with the risk of going bankrupt anytime soon, but in order for shareholders to enjoy the quote-unquote upside, you need to believe that Mark Zuckerberg and his team can deliver and steer his ship as the tide comes. So this is essentially a risk-value transaction, if you caught that analogy previously. When risk has been killed, then value has been created, and a subsequent investor should theoretically pay a higher price for ownership. Number 2, forget about the previous valuations of Meta, where it was trading near $380 with a $1 trillion valuation. This won't be a quote-unquote, I buy now and I just pray that the market gives them back their multiples again investment. Moving forward, although many shareholders will probably still be extremely fixated with metrics like user growth, average revenue per user, engagement rates, etc., I think analysts will start paying more attention towards the growth of Reality Labs as well, and also the advancement of said technologies in augmented reality and virtual reality. Also, I think we should forget about the 12 times price to earnings that is currently ascribed to Meta Platforms. Earnings will definitely take a hit, and we just have to work with that. Don't buy into Meta just because it has a PE of 12 and you think that it's cheap. Number 3, even at current valuations, there seems to be more downside to the company because there is still a lot of room to punish companies, especially those that are quote-unquote in transition, if I might put it that way. This is not just a normal gender transition, but the whole company's identity. Besides, competitors are not going to slow down either, so you might wish to proceed with caution. So I found this tweet thread particularly insightful. What do you think? Leave in the comment section down below. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!